begins with one simple question. What happens when a country says it will no longer wait for government budgets alone and instead invites private capital to build its roads, its rails, and its future? In Kenya today, that question is being answered in bold letters. This is a story of Kenya's transport revolution, based not just on public funds but on public-private partnerships, or PPPs. Over the last decade, Kenya has raised more than $1 billion in private capital under the PPP model. And now, with the government targeting multiple billion-dollar transport projects, the total investment pipeline is easily stretching towards $5 billion. This is about more than roads, it's about mobility, economic growth, and connectivity. Today, we take a deep dive into how PPPs are transforming Kenya's transport infrastructure, how projects are funded, what they mean for commuters, and why this matters for Kenya's economy. A public-private partnership is a model where the private sector designs, finances, builds, and operates infrastructure, while the public sector provides oversight, regulation, and long-term concession frameworks. In Kenya, the model has become a key mechanism under Vision 2030 and the push for faster infrastructure delivery. It matters because Kenya's public debt is high, budgets are constrained, and yet the demand for modern transport is growing by the day. Rather than waiting for government appropriation, PPPs allow Kenya to tap into private capital, shift risks, and deliver infrastructure faster. But PPPs alone come with challenges. They must deliver value, transparency, and long-term viability. And in Kenya's transport sector, that test is underway. Let's begin with the most visible example, the Nairobi Expressway, a 27-kilometer tall highway connecting Jomo Kenyatta International Airport to Westlands via elevated ground-level carriageway. Costing around $668 million, the project was financed via a build-operate-transfer model under a 30-year concession. The private partner, China Road and Bridge Corporation, took major equity, and the Kenyan government granted the concession to recover investment through toll revenues. Why does it matter? Because this expressway dramatically cuts travel times from over an hour in traffic to around 20 to 30 minutes in ideal conditions. That means less fuel wasted, less time lost, and more productivity unlocked. But it's not perfect. In the 2023-2024 financial year, the expressway posted a loss of 1.2 billion Kenya shillings, highlighting that toll revenue, exchange rate shifts, and traffic projections remain real risks. This case highlights both the promise and the caution of Kenya's PPP model. Nairobi Expressway isn't alone. Across Kenya, dozens of transport PPPs are underway or planned. For example, private investment inflows into Kenya's PPPs have reached 145 billion Kenya shillings since 2013. Consider the Nairobi-Nakuru Mau Summit Highway, budgeted at around $1.8 billion, expanding 180 kilometers of road into a 4-lane dual carriageway, expected to be financed via public-private consortium with Kenya's pension fund as investor. Or the Lamu Port, South Sudan, Ethiopia Transport Corridor, LAPSSET, worth over $24 billion, designed to connect Kenya's coast to East Africa. While many parts remain early stage, the ambition is clear. At the same time, smaller scale PPs in county roads are advancing. 170 kilometers of urban roads across 11 counties, financed under design, build, finance, operate, maintain terms of around 13 billion Kenya shillings in total. These patterns reveal transport revolution built on layered infrastructure investment, toll highways, regional corridors, and local federals, all under PPP model. Why should you, the Kenyan commuter or investor abroad, care about these projects? Because transport infrastructure is the circulatory system of the economy. Roads, trains, and ports define how fast goods move, how jobs are assessed, and how cities expand. The Nairobi Expressway alone is projected to reduce travel time, fuel consumption, and maintenance costs. On a larger scale, projects like LAPSSET are designed to stimulate trade, logistics, and manufacturing. Public-private investment unlocks potential beyond just cement and asphalt. For Kenya's economy, efficient transport means higher GDP, lower logistics costs, and greater competitiveness in East Africa. With the transport sector capturing both private capital and ambitious public policy, Kenya is positioning itself as a regional infrastructure hub. Of course, transforming transport via PPP isn't without risk. Toll rates on the Nairobi Expressway are dollar-linked and inflation-indexed, which exposes users and the operator to currency volatility. Other PPP road deals have been cancelled, delayed, or renegotiated due to cost overruns or political intervention. The government has to balance public interest, private returns. And then there is the question of equity. Will these toll roads and high-cost initiatives benefit everyday citizens or disbenefit higher-income road users? Ensuring accessibility while delivering returns is a key tension. Looking ahead, Kenya plans to push further. More highways, train lines, port upgrades, and regional corridors are on the table. With the transport PPP pipeline possibility hitting $5 billion in the near term, the next decade could redefine how Kenya moves. For the Kenyan commuter, this could mean a future where traveling from Nairobi to Mombasa takes less time. Durban-like connectivity becomes a reality, and urban sprawl is kept in check by efficient links. For investors, the message is Kenya is moving from budget-funded projects to private capital participation. If you're watching this channel and you believe Kenya's transformation matters, please subscribe and turn on notifications. Share your thoughts in the comments. Which transport PPP project excites you most? The toll highways, the regional corridors, or the urban roads? Your answer helps shape future videos on this channel. Thank you for watching. This is just the start of Kenya's transport revolution, and we'll be tracking it project by project.